Hi again, everybody. Mr. Drummond coming to you today, April 3rd, Friday. Hope everyone's doing well. Made it through another week. Got the weekend coming up. Hopefully, spend some time with some family and others that you're living with. Obviously, don't want to be going and doing any traveling, but take some time to relax. We got some nice weather coming up, so hopefully some good things, some things to be excited about. Hope everybody's doing well. Okay, I know it's hard. This is something that you're going to tell your grandkids about living through, but hopefully we're staying positive, enjoying some time to relax, and also taking care of our schoolwork stuff. So, speaking of schoolwork, I thought it would be a good idea before the weekend came to post the conclusion of our discussion of how the government influences the economy, right? What things can the government do to influence the performance of the economy? Okay, so the government and the economy. All right, we had some readings on this in your assignments that you were given last month that you're continuing to work through. So I just thought we'd finish up that discussion and talk a little bit more about what the government can do to speed up the economy or slow down the economy, depending on what needs to happen, okay? So just as a quick review, economy, we're talking about the ability of the country to produce goods. We're talking about things like unemployment figures. We're talking about things like GDP numbers, right? How much of a product, how many goods and services can a country produce? Okay, the government, okay, has two areas of policy that it can use to influence the economy, right? To make it go faster or improve, to make it go slower or slow down. Okay, those two things are monetary policy and fiscal policy. We talked about fiscal policy in our last video, right? Fiscal policy has to do with taxing and spending. Who's in charge of taxes and how much money the government spends? Congress and the president. They work together to come up with tax rates and to come up with the amount of government spending we're going to do. How do those two things influence the economy? Well, remember, we used kind of the analogy of the, of the bonfire, right? Or you can think of a car going down the road, right? We want it to go with the pace of traffic. We want it to go, we want to get where we're going, but we don't want to go so fast that we get into a wreck. We don't want to go so slow that we get, passed up and we never get where we're trying to go. So fiscal policy, let's start with speed up. How do we get the economy going if it's starting to struggle? There's two levers that we can pull, right? When it comes to fiscal policy, taxing and spending. So if we want the economy to go faster, if we want that fire to burn brighter, if we want that car to go faster, we can decrease the amount of money citizens are paying in tax, and we can increase the amount of money the government is spending in the economy. How does that work? Well, it's that domino effect again, right? Lower taxes, that means citizens are giving less money to the government. They hold on to more money. The more money they have, the more money they'll spend. The more money that gets spent, that means demand is going up in the economy. When demand goes up, prices go up. When prices go up, firms and companies that produce goods are encouraged to make more stuff. When they make more stuff, they need more people. When they hire more people, those people now have a paycheck. Those people can use their paycheck to buy things in the economy. Demand goes up again and the circle continues. Same thing with government spending, right? When the government spends money, the government is huge. The United States government is enormous. It spends a crazy amount of money in the economy. If the government starts to spend more, that's going to take demand for all kinds of goods and increase it, right? And we use the example of, if the government decided to invest in building new roads and bridges and airports and rail lines, the companies that build roads and bridges and airports and rail lines would have to hire more people, okay? People get hired, they have a paycheck, they go out and spend it, demand goes up again, right? That's speeding it up. Slow it down. Why do we want to slow it down? Another little bit of review. That I word, inflation. Inflation is about too much money and out in the economy chasing too few goods, right? The prices of these too few goods go up because demand has gone up, but it goes up too fast. A little bit of inflation is a sign of a healthy economy. That means people have money to spend. Not all inflation is bad, but when inflation gets rising too quickly, it eats away at the value of every dollar, right? So yes, you're earning more money, but everything costs more. Sometimes we have to slow the economy down so that inflation doesn't eat away at the value of the money people bring home. So how would we slow down the economy? Well, it's all about bringing demand down. So we could raise taxes, right? If you raise taxes, people have less money to spend. People have less money to spend. They put off purchases, right? They don't get that new car. They don't get that new refrigerator. They don't get that new roof on the house, whatever it may be. Demand in the economy, excuse me, demand in the economy goes down. Demand goes down, prices go down to meet it, right? If people aren't buying your goods, what's really the only thing you can do as a company? See if they'll buy it if the price goes down. When the price goes down, there's no incentive to make more because you're not making as much money. So if you don't need to make as much, you don't need as many people working for you. If you don't have as many people working for you, you lay people off. Now they don't have a paycheck anymore. They don't have a paycheck. They're not spending. Demand goes down again. All right. Same thing with the government spending. If the government pulls back out of the economy and they start to spend less, then demand goes down and that whole cycle begins again. Okay. Now, let's talk about the second part of that equation. Fiscal policy is taxing and spending. Monetary policy, M-O-N-E-T-A-R-Y. What word's at the core of that? Mana, money, monetary policy. It's all about how much money is available in the economy, right? How easily accessed is credit? How expensive is credit? Getting a loan, okay? So monetary policy is set by the Central Bank of the United States. We call it the Federal Reserve. Sometimes we call it the Fed, okay? It is in charge of setting monetary policy. It's directed by a board of governors who are appointed by the president. But what's unique about the Fed, we said in the last video, they act independently. They don't have to get anyone's permission to take actions, okay? And they're able to move pretty fast, okay? Congress and the president, that takes time. That's a slow process. The Fed can take decisive action quickly, okay? So that's one good thing about it, all right? They're the bank's bank. That's another way to think of them, okay? So monetary policy, let's talk about three things, all right? Three types of monetary policy. The easiest one, they're all easy. The first one we should talk about is called our interest rates. Interest rates, okay? And everybody knows about interest, right? Even in the, when you guys are growing up, somebody says, hey, can I borrow $1, right? And you say, yeah, if you were a entrepreneurial young person, right? You said, yeah, I'll give you $1 if you give me $1.50 next week. And then everybody gets something that they want, right? That person that wanted $1 for a Hershey bar, they get their Hershey bar. You had $1 that wasn't doing anything. It was just sitting in your pocket. And now you've used it to make 50 cents, right? And that's a 50% interest rate. So you made a pretty good deal there. But, excuse me. Oh my. The principle is the same with banks. When you go to the bank, any bank, all right, when you want to, one day when you go to buy a car, when you go to buy a house, when you go to put a new roof on your house, when you go to do if you want to build an addition onto your house, if you want to buy a boat, a motorcycle, if you want to buy, put new carpet in your family room, whatever, okay? These things that cost a lot of money, say a car, say a nice car, $30,000 for a, nice, not ridiculously expensive, but not cheap either, say $30,000. Most of us don't have $30,000 just lying around, okay? We need to get a loan, right? Banks give loans and everybody gets something that they want. I get $30,000 from the bank to buy my car, okay? The bank takes $30,000 that was just sitting in its vault and they make money off of it, right? They make, a few $1,000s or more, okay, depending on what the interest rate is, because they're going to charge you interest, okay? Interest is how we get people willing to take the risk, right? Because there's a risk, right? You might not pay back that loan, okay? You might lose your job and default on the loan. So to cover their risk and to make it worth a bank's while, they charge you interest, okay? So you pay back the principal amount of the loan, right? If you borrowed $30,000, you're going to give back $30,000 plus interest, okay, of a few $1,000s, okay? The bank, that's where the bank's making its money. That's how banks make money, okay? So the interest rate is really influential in people's decisions about whether or not they want to buy, okay? Remember, we said that the Federal Reserve is the bank's bank. Where do banks get money? Well, they get it from people, depositing money, right, in a savings account. Like if you go and put $100 in a savings account, that $100 isn't just going to stay in a vault in the bank. The bank is going to use that money to loan out to other people, okay? And the bank's going to make money off your money, okay? But the important thing to remember with the interest rate is that's not the only place banks get money. Banks also borrow money, right? The bank's bank is the Federal Reserve. So banks will go to the Federal Reserve and say, hey, lend us some money. You lend us money, we're going to send the money out into the economy. What do banks do? How do they make money? They charge interest. So what do private banks pay to the Federal Reserve? They also pay interest. We call that the discount rate. Sometimes it's called the overnight rate, okay? But it's how expensive it is for your bank, your private bank, Huntington, Home Savings and Loan, whatever, to borrow money from the Federal Reserve, okay? So if the Federal Reserve lowers that interest rate, what is that going to allow banks to do? Do what to their interest rate? They can also lower it. Okay, if interest rates are low, what are people going to want to do? They're going to want to borrow, right? Hey, it's a good time to borrow because the cost of a loan, the interest rate that you pay on it, is very low. Okay, if it's $100, for every $100, if it's 2% interest for every $100, you pay $2. If it's 5% interest for every $100, you pay $5 in interest. So obviously lower interest rates are going to encourage people to go out and get loans. So what's that going to do to the economy, you think? If more people are going out and getting loans from banks, are you going to go get a $30,000 loan and then just sit on it? No, you're getting a loan because you want to do what? Go buy something, right? So when the Fed lowers the interest rate that they charge to banks, banks can lower their interest rates. That encourages people to come into the bank and get a loan. When people get loans, they turn around and spend that, okay? You get a loan to buy a car, buy a house, buy a refrigerator, buy whatever you need, buy a big screen TV, okay? When interest rates are low, that encourages people to borrow. When people borrow, more money goes out into the economy, demand for things goes up, prices go up, people hire, firms hire more people to make more of that product, okay? When people are hired, they have a paycheck, right? When they have a paycheck, they can then spend that paycheck. It's that same cycle, right? Demand goes up because interest rates are low. When interest rates are low, it's cheap to borrow, so people will go and borrow and then spend. Make sense? So that would be expansionary. We're trying to expand the economy with low interest rates, okay? The other thing would be contractionary. So if to expand the economy, we lower interest rates. To contract the economy, what do you think we do with interest rates? Very good. We raise them, okay? Banks, the Federal Reserve charges banks more money to borrow. If I'm a bank that's getting charged more interest from the Federal Reserve, what do I have to do to my rate in order to still make money? I got to increase my rate too. If I'm a consumer sitting at home and saying, I'm thinking about buying a new car. All right, let me look at interest rates. Oh, they're pretty high right now. Remember, a high interest rate means that it's more what to borrow money? It's more expensive. So you know what? Hey, my car's okay. Let's try to get through another year with it, right? It's not an emergency. I don't need a car. I want a car, right? I have one that works. I'm going to put off that purchase, right? If people are putting off purchases because credit is expensive, what's that going to do to demand for big ticket items? Cars, houses, big home improvements, new furnaces, new, hot water heaters. If you can afford to put it off, what will you do? You'll put it off, and hopefully what will happen? Interest rates will go down, okay? So interest rates goes up, it becomes more expensive to get a loan. When things become more expensive, people tend to buy less of it. When people get fewer loans, they're not going out into the economy and making big purchases. Demand goes down, prices go down. When demand and prices go down, people don't make as much. When people don't make as much, they don't need as many people to make the thing that they make, right? Say it's a car company. When people don't need as many people when companies don't need as many people to produce what they want, people get laid off. When people get laid off, they don't have a paycheck anymore. When you don't have a paycheck anymore, you have less money, you spend less, and demand goes down again. When demand goes down, what else goes down? Prices. And that's the key point. That's what we're trying to do. We're trying to drive prices down to fight inflation. That's why we would do this. Okay? Make sense? Interest rates. They go inverse with the economy. When interest rates go up, the economy tends to go down, slow down, right? When interest rates go down, the economy tends to heat up because people go and get loans. It's easy to get access to credit. People spend more because it's easy and cheap to get loans. Okay? 2 more to go through. That was the most important one. These 2 are also important, but that's the biggest thing to understand. Interest rates go down. Demand in the economy tends to go up. Interest rates go up. Demand in the economy tends to go down. And then when demand goes down, prices go down. And that's what we're trying to control with contractionary monetary policy. Okay? Next one. Government securities. Okay? These next 2 are all about how much money the banks have available to loan out. So we've talked about how the United States has debt, right? One of the ways that it goes into debt is it sells government securities. A big purchase, and all that is it's an IOU. It's the federal government saying, you give us money now, in the future, we'll give you more than what you paid, right? It's a real safe investment. A lot of banks have a lot of these government securities. They hold on to them. It's an IOU. In 6 months, in a year, in 5 years, in 10 years, right? It's going to be worth this amount of money. I paid $85 for it, and it's going to be worth $100 when it's mature. Okay? What the Fed will sometimes do, okay, in order to get more money out into the economy, is they'll go to a bank and say, hey, bank, you've got these securities that they're going to be due, they're going to come due in 5 years. I'll buy them off you right now, okay? The Federal Reserve Bank will go to other banks and say, you give us these IOUs that the government owes you, we'll buy them from you right now at whatever percentage of their value. We'll buy them. We want to take them from you. And when you buy things, what do you give in exchange for the thing that you want? The federal government wants to get this security back. So they're going to give the bank what? Money. Okay? So now the bank has given over this IOU back to the government, and in return, the government has given them money. The government goes out and buys all of these securities from banks. What does that do? Well, what's getting pumped out to the banks and to the economy? What do they have now? They don't have the IOU anymore. They've got actual money. Banks don't want to have a lot of money. They don't want to be swimming in a bunch of money, because if they have a bunch of money on hand, it's not doing what for them? They're not making any money on it. So what are they going to turn around and do? Hopefully, they're going to take that money that they got from selling these securities, and they're going to loan it out, because that's how banks make money. If there's a lot of money being put, if the banks want to push out money, what are they going to do to their interest rates to try to entice people to come in? They're going to lower their interest rates, right? When interest rates are lower, people are more excited about borrowing because it's cheaper, and we get back into that whole cycle that we've talked about, okay? But the Fed looks around and says the economy's slowing down. When the economy is slowing down, we want to get more money out into the economy, so we're going to go around to banks and we're going to offer to buy off of them these securities, these government securities, these bonds, okay? We give the bank money right now, we get the IOU back, okay? The bank now has money to loan out. Banks don't like having a bunch of money just sitting around doing nothing for them. They want that money making money for them. So they're going to lower their interest rates to encourage people to come in and get a loan. Okay. What's the opposite of that? What's the opposite of buying? Selling. So they go out and they try to set rates on these securities that encourage banks to do what? Well, that's a pretty good deal. I'm going to buy government debt. I'm going to buy this security from the government, from the Federal Reserve. Okay. When I buy something from the Federal Reserve, now things are going in the opposite. I'm taking money and giving it to the Federal Reserve, and the Federal Reserve is giving me an IOU, which right now doesn't really have a value, but in 5 years, 10 years, 6 months, whatever the term is, will. So I don't have money now, but I'll have money later. So what are banks doing? They're taking money and not loaning it out to people, but giving it to the Federal Reserve. Okay? When you give money, when the banks take money and buy securities with it, there's less money to give loans with. All right? When there's more competition for fewer loan dollars, what can banks do with their interest rates? There's a lot of people that want not a lot of money. They can raise their interest rates. When interest rates go up, what happens to the economy usually? It goes down, or spending goes down, right? I don't want to get a loan when there's a big high interest rate. I'll wait until interest rates come back down. Okay? Last thing is called the reserve requirement. Okay? So remember earlier how we said when you go and give $100 and say, put that in my savings account, the bank doesn't just take your $100 and turn around and put it in the vault and lock it up and forget about it. They take a fraction, a percentage of that deposit, and they turn around and make money with it. They loan it out, okay? Now, they know that why can they do that? Because it's very unlikely that on one particular day, every single depositor is going to come and take 100% of their money out of a bank on a given day. So they don't have to have on hand every penny that people deposit with them. they have to have a ratio of it. They have to have a percentage of it. Who makes that rule? The Federal Reserve. All right, so let's think about this. Okay, if the Federal Reserve, let's go decrease first, right? If they decrease the amount of money that banks have to hold on to, what are banks allowed to make more of? Think about your $100. If the amount of that they have to hold on to goes down, the reserve requirement goes down, they can take more of your money and loan it out. So there's more or less money available in the economy. There's more, right? Banks don't have to hold on to as much of it, right? They can give away way more of your $100, okay? Their reserve requirement is lowered, okay? We do this when we want to pump money out into the economy. We basically lower these reserve requirements when we want banks to get it out as fast as it's coming in, right? We want people to get loans so that they take loans and spend money, okay? Reserve requirement. The amount of money a bank has to hold on to of your deposit or of all deposits that they have, right? So if a bank gets $100 deposit, what percentage of that are they allowed to turn around and loan out? Is it $80 of that they can loan out? Is it $85 of that they can loan out? Is it $87 of that they can loan out? The more they're allowed to loan out, what's that going to do to the economy? There's more money available. There's a lot of money competing for lenders competing for people getting loans. They're going to drive their interest rates down. When interest rates go down, people tend to want to get credit because it's cheap. When credit's cheap, people spend more. When people spend more, demand goes up. Why is this all happening? Because the Federal Reserve has said to banks, hey, don't hold on to as much money as we usually tell you to. We're going to lower the reserve requirement. You don't have to keep as much cash on hand. Take it and get it out. By the same token, if they want banks to slow down their lending, they can take that reserve requirement and increase it. So now the bank has to hold on to more of the money that they take in deposits. If they have to hold on to more money, what can they do less of? Loaning, right? Banks have to keep it, hold it in reserve. They can't send it out, okay? When there's fewer dollars available to loan out, what can banks do? There's more people that want loans than they have money available to give loans. There's more competition. They can send their interest rates up. When interest rates go up, the economy tends to go down because demand goes down because people don't want to make those big ticket purchases when interest rates are high, right? If I said that, you can buy this and you're going to pay over the course of the term of a loan, $5,000 in interest, or you can wait 6 months and you'll pay $3,000 in interest, you're going to wait. So if people are not running out to get loans, the economy is going to slow down. Demand goes down. What else goes down with demand? Price. And remember, price is the thing we're trying to control with contractionary, monetary, or fiscal policy. We want to keep prices under control. Okay? Again, a lot of information there. I will post probably next week another review. Try to go into a little more detail about individual topics. But monetary policy, here's what you need to know. 3 things encompass monetary policy. The interest rate, the Federal Reserve sets that by how much do they charge banks to borrow from them. When they charge less, banks can then charge less to the people they give loans to. Interest rates go down, demand for loans goes up, the economy speeds up. Buying and selling securities is number 2. Those IOUs from the federal government. If the Fed wants to speed up the economy, they'll go out to banks who hold millions and billions of dollars of them, and they'll buy them off of them. The bank gets money right now, the Federal Reserve gets the IOU back, and there's more money in the system. When there's more money in the system, interest rates can go down, encourage people to come in and get a loan. People get loans. They don't just sit on it. They're going to go out and spend it on the car, the house, putting an extension on the house, whatever it may be. Okay. If the Federal Reserve sells securities, they take money out of the system. Okay. Buying speeds it up because they're giving money to banks. Selling slows the economy down because they're taking money from banks. Okay. And the last thing is the reserve requirement. How much money do banks have to hold on to of the deposits that it has on any given day? What percentage of those deposits does the bank have to be able to cover? If the reserve requirement goes down, that means they can do more what? Loans. They can push more money out the front door. When they're trying to get rid of money and they're trying to get people to come in and get a loan, they're trying to compete with other banks that are also trying to push money out the door. What's going to happen to interest rates? They're going to go down. When interest rates goes down, the demand goes up, prices go up, companies want to produce more. When companies need to produce more, oftentimes they got to hire new workers. When new workers get hired, now they have a job. When new workers have a job, they get a paycheck, they can turn around and spend that money. Demand goes up again, and the cycle continues. If the Fed wants to slow the economy down, they will increase the reserve requirement. They're going to make banks hold on to more money. They're not trying to get as much out the door because the Federal Reserve's telling them you got to hold on to a bigger percentage of your deposits. So banks can't give out as many loans. When there's fewer loan dollars available, that allows the banks to be more selective. They can increase their interest rates. When interest rates go up, consumers are less likely to try to get a loan. When you don't get a loan, you're not going to spend it. When you're not spending money, demand within the economy goes down. And then our cycle continues. Demand goes down, prices go down, production goes down, employment goes down, employment goes down, demand goes down again, and it's a spiral. Okay? So we went over a lot this week. Tomorrow's a new week. Hope everybody has a enjoyable weekend. I hope this helped you a little bit. I'm sure all of you will spend all of Friday night, really going over this. Probably not. That's okay. Look at it on Monday if you can. All right. We'll come back on Monday afternoon. I think I'm going to have a Zoom meeting on Monday afternoon just to try to hopefully check in with some folks and see how you're doing, what I can do to help you out. Okay. So stay strong, hang in there, keep swinging, and have a good weekend. Talk to you later.